The US stock market remained relatively calm last week without showing signs of growth. This is rather curious given the fact that this week the Fed announced its intention to support the economy as long as it takes. The regulator said that it would keep key rates at a minimum level of 0.125% until at least 2023. It will also continue to inject liquidity into the markets, buying at least $120 billion of bonds each month. Earlier, Joe Biden signed into law his ambitious $1.9 trillion stimulus bill to revitalize the economy. However, the market lost ground due to a temporary high level of money injections. So now let's take a closer look at the major US stock indices. Last week, the Dow Jones fell by 0.5% after rising for two previous consecutive weeks. Nevertheless, investors continue to monitor the situation with the U.S. Treasury yields. The 10-year U.S. bond yield dropped to 1.68% on Monday, down from 1.73% on Friday. Shares of tech companies advanced amid such news. The tech sector, which has benefited the most from the coronavirus crisis, came under pressure in recent days due to the constant growth of the U.S. Treasuries. The S&P500 index is trading at 3,940 at the start of the new week, after having lost 0.8% over the past week. The reason for the decline was the same: rally in the bond market. This week, the S&P 500 rose by 27.49 after the two-day decrease logged at the end of the last week. The NASDAQ composite is demonstrating similar dynamics. It lost about 70 points but recouped its losses by Friday. In addition, on Friday, the index showed the highest one-day gain in about a week and a half. The main U.S. indices are highly likely to remain near the current levels in the coming week. The Dow Jones is expected to stay in the range of 33,000. The S&P 500 stock index will trade in the range between 3,600 and 4,200. The NASDAQ composite, which represents a basket of the 100 largest, most actively traded U.S. companies, will remain mostly at the level between 13,400 and 14,000. Meanwhile, the shares of the main companies have shown very peculiar dynamics over the past week. The capitalization of IT solutions firm Cinex soared by 6.5% after it announced a merger with PeerTech Data in a deal worth about $7.2 billion. The market value of Tesla jumped by 2.3%, getting a lift from the bullish report from ARK Invest. Influential shareholder of Tesla, Catherine Wood, predicted that the shares of the electric car manufacturer would climb 4 times by 2025 to $3,000 apiece. However, on Monday, Tesla's stock price lost its previous gains. Investors were also surprised by an 11.1% increase in Kansas City Southern's shares on Monday. Canadian Pacific Railway and Kansas City Southern announced that they had entered into a merger agreement. CP has agreed to acquire KCS for $29 billion, which was slightly higher than the forecasts. Stock prices have risen significantly and at a quicker pace. This is why large investors currently refrain from buying stocks, as their price is rather high. In this situation, two scenarios may occur. The first one suggests a long period of index fluctuations up and down at the same levels, while the second one conjectures a pullback in case of publication of important macroeconomic data. For instance, the reason for a drop could be a new round of the US-China trade war or the growth of the US Treasury yields. So last week, Fitch, one of the 3 largest world credit rating agencies, predicted that the Fed would be forced to start raising the interest rate in early 2022. The likelihood of the third wave of coronavirus in Europe as early as April also represents a risk for the US stock market. If vaccination rates remain low in large EU countries, the euro area is likely to experience a new pandemic peak, reimpose lockdown measures, and suffer an economic downturn. You've watched Weekly Financial Review on Insta TV with me, Anna Kasatkina. See you back soon.